Trading is not about achieving perfection, it's about persistence, learning, and growth. As Richard D. Wyckoff aptly emphasized, the key to success is not just studying the markets, but studying yourself. Let's dive into the principles that can help you turn mistakes into milestones on your trading journey. The foundation of successful trading lies in continuous learning. Wyckoff reminds us that the markets are a complex ecosystem, requiring dedication to understand their nuances. To thrive, traders must analyze market behaviors, review successful and failed trades, and consistently seek to understand the principles driving these movements. Without this commitment, impulsive decisions take over, leaving traders at the mercy of luck, a perilous and unsustainable strategy. Dedicate time to reading market reports, analyzing charts, and studying historical trends. But don't stop there, evaluate your performance regularly to identify areas for growth. Mistakes in trading are inevitable, but what sets great traders apart is their ability to learn from them. Rather than viewing errors as failures, see them as opportunities to refine your strategies. Document each trade meticulously. What was your reasoning? What was the outcome? What lessons did you learn? For example, if you find yourself holding on to losing positions for too long, implement a tighter stop-loss rule. This approach prevents recurring errors and fosters continuous improvement. Foresight is the ability to anticipate market trends by combining analysis, intuition, and experience. According to Wyckoff, this skill distinguishes successful traders from the rest. Develop foresight through studying market patterns, analyzing macroeconomic indicators, and understanding sentiment. Use tools like moving averages, volume analysis, and trend lines to predict market movements. While prediction may not always be perfect, even limited foresight can mean the difference between consistent profits and losses. Judgment is the trader's compass. It enables you to assess risks, identify opportunities, and make timely decisions. Good judgment ensures trades are rooted in sound reasoning rather than speculation or impulse. Avoid all-or-nothing decisions. If uncertain, test the waters with smaller positions rather than committing heavily. Over time, with experience and discipline, your judgment will become sharper and more intuitive. The markets are dynamic, constantly evolving. Strategies that work today may fail tomorrow. Wyckoff stresses the importance of flexibility and adapting to new data or trends. Rigid adherence to a single strategy often results in losses. For example, if a buy-the-dip strategy fails in a bear market, consider short selling or pivoting to safer investments. The ability to adapt is not just a skill, it's a survival mechanism for long-term success. Maintaining a trading journal is one of the most powerful tools for self-assessment. By recording your trades, you gain insights into patterns in your behavior, recurring mistakes, and areas for improvement. Document entry and exit points, reasons for the trade, and results. Regularly review your journal to refine your strategies and maintain a disciplined approach to trading. Trading principles are the guardrails that keep your decisions aligned with logic rather than emotion. Wyckoff advises traders to establish rules that guide their actions, especially during volatile market conditions. For example, a principle could be setting stop-loss orders at 2% below the entry price to prevent significant losses. Before entering a trade, use a checklist to ensure it aligns with your predefined principles, such as trading only in the direction of the trend. A few successful trades can create a dangerous illusion of invincibility. Overconfidence often leads to excessive risk-taking, poor judgment, and, eventually, significant losses. Even after a winning streak, adhere to your risk management principles. Avoid the temptation to drastically increase position sizes, as this can amplify the impact of a single bad trade. Every trade should be evaluated with a clear understanding of its risk-to-reward ratio. Successful traders aim for scenarios where the potential reward far outweighs the risk. Wyckoff recommends a reward-to-risk ratio of at least 3 to 1. For instance, if your stop-loss is set at $1 below the entry, your target profit should be at least $3 above it. This ensures that even with some losses, your overall profitability remains intact.